Hey, Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you get any sort of value or intent out of this video, I ask you to hit thumbs up and subscribe. Questions, comments, put those below. I want to unpack the Bank of Canada rate hike announcement just this week, the implications for the housing and mortgage market, and kind of what we're looking forward to in 2023. So as it's well been documented, the Bank of Canada raising rates 50 basis points. That was pretty much in line with what economists were expecting. The market was pricing in roughly about 25 basis points. So really nothing that was overly surprising. I think what's more interesting enough is actually the tone from the Bank of Canada. It was actually, funny enough, it was an oversized rate hike, 50 basis points, but it was actually a dovish rate hike. If you look at the way the bond market reacted post rate hike, if you look at market expectations, etc., after that rate hike, it was really a nothing burger. And in fact, it was the language from the Bank of Canada which really ultimately signified that. The Bank of Canada basically signaling that they are now going to be basically data dependent. So you remember over the last 3, 4, 5, 6 months, even the last rate hike that we had previous this one, the Bank of Canada basically came out and said, listen, we expect rates will still need to go higher. So they were basically telling the market, listen, we need to raise rates. We just raised rates. We're going to keep raising them. Well, this time around, they basically came out and said, we're now going to figure out if we actually need to raise rates. And so the following day, the Deputy Governor of the Bank of Canada actually came out and made some clarifying comments, which I found very interesting. So let's clip those right here.
We've tried to stress that the change in our communication between the decision that we made in October and then the decision that we made yesterday is that we feel like we've gone from a world where we were trying to decide how much each policy rate increase needed to be to a world where we're now asking the question of if we need to be increasing the policy rate by more.
So again, they're going to start assessing the economic data and letting basically the 400 basis points now of rate hikings go into effect to figure out how that's going to impact the economy. Remember, per the own central bank's data, it takes interest rates at least 12 to 18 months to actually filter through into the real economy, right? The first thing that feels interest rates is highly interest rate sensitive parts of the economy, such as housing. And of course, the sell-off in housing has been pronounced. We've talked about it on the show numerous times. The National House Price Index is down 15% since peak earlier this year. It's the steepest decline on record since the index was created in 2005. And it's really only been, 8 or 9 months of a correcting housing market. If we look at housing market activity on a year-over-year in the month of November, we reported last week that Greater Vancouver home sales were down 52%. We reported that Toronto was down about 53% as well. You had Edmonton down 31%. You had Montreal down 38% year over year in the month of November. So, really we have I would call it a severe bear market in housing that is only going to get worse given the fact of where Bank of Canada has taken rates. Now, again, my personal view, I don't get dogmatic about this, but anyone that was watching these videos, following the channel for a number of months, years, etc., you guys know that I was the first one to sort of flag the boom in the housing market. And when the Tiff Macklem and the Bank of Canada was coming out and saying, oh, it's just a bit of pent-up demand from the pandemic, people are just buying housing because they're working from home, I was the one that was calling out and saying, listen, this thing is a runaway freight train and this thing's going to ratchet higher. And that was towards the end of 2020 and into 2021. And of course, it wasn't transitory. It was a housing bull market that got completely out of control. And these guys missed it. So these guys started raising rates in March of 2022, officially 1 month after rates had the housing market had already peaked. Remember, the housing market peaked in February of 22, and they started raising rates in March. So just like the Bank of Canada was too late in raising rates, they're going to be too late in reversing course, which is, when I say reversing course, I understand there's a cohort of people out there that are hoping for a bear market in housing, hoping for a reset in prices, because that is, long term, that's probably what's best and healthy for the market. But that's not how the central bank thinks. I'm looking at this through the central banker's lens. The central bankers don't want a deep recession. They don't want a housing crisis with a whole bunch of people foreclosing. That's not what the central bank. That's not how that's not how they think. So when they're basing these 400 basis point rate hike moves, that's not their intention. And so the cohort of people that are saying that, when I come out and say they're going to be too late to pivot, because I'm saying is that they're going into I think a decent sized recession given where housing activity is. And again, I highly encourage you to go check out the report for the NBER. NBER was a report that was written by National Bureau of Economic Research, which basically said in 2007 they published a report called "Housing is the Business Cycle," basically, which it says that housing has historically always been a leading indicator. So as housing rolls over, the rest of the economy typically follows suit, because housing, particularly residential housing, is such a large component of the consumer's life. It is typically your largest asset. It's highly interest rate sensitive. You have the wealth effect implications of that. And so all these various knock-on effects of your housing market. So that's the one thing. And obviously, you've got to focus on bank lending as well. And we have to look at the overall implications of this moving forward, which is the Bank of Canada, by raising rates 400 basis points this year, but 1/3 of the Canadian housing market is on a variable rate mortgage. The Bank of Canada has prior to this rate hiking cycle, about 50% of all fixed payment variable mortgages already hit their trigger rate. So I'd imagine anyone that's on a fixed payment after this most recent 50 basis point has been triggered as well. So you basically have every single fixed payment variable mortgage is essentially turned into an interest-only loan. So people are no longer building savings through principal pay down. In fact, most of them are having resets into higher monthly mortgage payments as well. That's going to pull from disposable income. And then you have your floating variable rate mortgages, which are all been impacted. Now, again, if you're in Vancouver or Toronto, let's say you're a young family, not uncommon to say, well, if you're a young family, you're probably looking for a 3-bedroom home. If you're looking for a 3-bedroom home, you're typically needing to shell out about $1.5 million to get a reasonable home that has at least 3 bedrooms in Vancouver or the GTA. So assuming that, you might be taking on $1 million mortgage. If you floated that, your monthly payments are up about $2,200 to $2,300 per month. So that is significant. Your prime rate is now at 6.45%. Minus your variable discount today, you're looking at variable rates of around 5.8, 5.9% at most Canadian banks. So you basically have these variable rates now at about 6%. The housing market where it's at today, the numbers just don't compute with 6% mortgages. So moving forward, we continue to see more downside market. I view this as a Bank of Canada pause. So we've now hit the pause stage in the rate hiking cycle. Despite the Fed and the ECB coming out next week, almost certainly going to be raising rates and probably going to be supersized rate hikes, the Bank of Canada, in my opinion, is done. I think that you're going to see other central banks such as Australia, New Zealand, they're also going to begin to slow the pace and probably hit pause as well. Central banks across the G20 are typically coordinated. They definitely all talk to each other. The Fed is going to outpace everybody because the U.S. consumer has the cleanest balance sheet. Now, again, this is the fastest rate hiking cycle in Canadian history, dating back. It's the fastest rate hiking cycle since the late 1980s. Now, basically, if you look at household debt to GDP in the 80s and even into the 90s, Canada was around 55 to 60% household debt to GDP. We're now at about 110% of household debt to GDP. So the ramifications or the impact from a 400 basis point move in rates is significant, despite rates realistically, historically, still being low. The overnight rate of 4.25% is not necessarily high by historical standards, but you actually add on the other denominator, which is the debt levels this is a huge tightening of financial conditions. This is a huge strain on household balance sheets, as I've just explained to you guys, right? $1 million mortgage, floating variable, you're up about $2,200, $2,300 a month. If you think, the typical family has an extra couple $1,000s a month of disposable after-tax income on top of all the inflationary costs that they're already being hit with at the grocery store, at the pump, etc. This is going to be a huge dent to the consumer. One of the things that I found really interesting is you're just seeing it's not necessarily showing up. So people are saying, well, look at, the labor market. The labor market's still strong. The labor market has always been historically a lagging indicator. All you have to do is go back into, first of all, Stats Canada historically notoriously horrible for their data series. It's extremely volatile and prone to massive revisions. In fact, the Bank of Canada actually commented on it this week as well. Clip that right here.
So the labor market is clearly an important part of the economy. And we've just received 2 months of data from the labor force survey in a row with increases in jobs. One of those numbers was very outsized. The other number, the latest number, was smaller. When you look over a larger period of time, that data can be really volatile. And so when you look over more like a 6-7 month period, we see that there haven't been a lot of new jobs created on average. That is suggesting there's been some slowing in the labor market than there had been a year ago when we were getting much larger increases in jobs every month. So we're seeing some signs of slowing.
And this is from my good friends over at Variant Perception. This is actually shows previous revisions going back to the last significant recession leading up to the global financial crisis. Again, the U.S. actually has better labor market data. You can see the massive revisions in 2007 at the onset of the recession, the huge revisions to basically employment numbers in 2007. So the labor market is not a leading indicator. So everyone's so focused on the headline number. Oh, Canada added 100,000 jobs last month, that the economy is not being shaken from interest rates. It's only the housing market. Keep going, keep going, keep going. You can't look at the labor market for a leading indicator. And that's why I continue to say, I think, again, per the Enber paper in 2007, housing is the leading indicator. I continue to see, personally, feet on the ground weakness, a lot of anecdotal stories building up. I think there's a lot of financial stress based on the people that I'm talking to, investors, families, people day to day trying to figure out, what to do and how to stomach this. And right now it is, okay, get through this, cut expenses everywhere else, and let's do whatever we can to service our mortgage. Let's drain our savings. Let's reduce our investment account. Let's call our investment advisor, tell them to sell some equities and use that to start paying down the mortgage. Various things like that. Renting out basement suites, putting an extra bedroom on Airbnb. So people are really getting creative with how to cope with this. So this is an important signal from the Bank of Canada. The problem now as we move forward is just because they hit pause by leaving rates in the 4s and having mortgage rates still in the 5s, there's still more pain to come. That is going to be painful. So the real question is at what point do we get the rate cuts? I don't know. I still think you get that recession. I think you get the rate cuts maybe Q2, Q3 of next year. That doesn't mean the start of a next bull market, but I think that the markets are pricing in rate cuts starting from the Bank of Canada, I believe in Q4 of next year. So we'll wait and see. As always, hope that helped. See you next week.